Hello, I'm Joe Walsh, Managing Director of Lepidico Ltd, ASX-listed lithium development company. We're in the process of transitioning our phase one project from the definitive feasibility study stage into development and then operations for first production in 2024. We don't just produce lithium. Our proprietary process technologies allow us to produce a range of other byproducts as well. So I'm thrilled today to be talking with you about the project, but also what we're seeing in some of our observations from within the lithium industry.
Joe, good to have you back. You're just the man I want to speak to. The lithium market is going a little bit crazy at the moment. Prices are going through the roof. We're hearing all sorts of things about supply chain. What can you tell us?
So we've seen this market evolving very rapidly. And I think a lot of your clients are aware that late last year, we entered into an offtake arrangement for our lithium chemical from the phase one project with one of the leading trading companies, Traxys. And as a result of that, we're having all sorts of conversations within the industry with groups that we already were engaged with, but also groups that we hadn't previously engaged with, or with groups that we're renewing conversations with. And we're really seeing now interest pushing down from getting supply from the major incumbent producers into the new producers, into the developers. And I think that there was a prevailing view amongst lithium consumers until probably middle of last year, late last year, that the industry would be able to increase output and satisfy demand, particularly for electric vehicle uses. What we're seeing now is that there's real concern that some major projects may not go ahead, like we have seen obviously recently. Rio Tinto's project Laggard in Serbia have its license revoked. Now that project was meant to produce 58,000 tons a year of lithium chemical into the market from one of the world's leading resources companies. It's gone. And so I think that in part has been a catalyst for this resurgent interest in what we're seeing. And literally, as every week goes by, we're getting more and more unsolicited interest in our product.
Let's talk about that, because I mean, Serbia. That's a huge project to be taken out of the market in one casual sweep. But also the bigger players, the Albemarles of this world. You're suggesting that they can't turn the volume up, turn the dial up in terms of production either. So why can't they do that? Because I remember speaking JP Morgan banker about 3 years ago and said, lithium is uninvestable. And I'll tell you why. It's because you just need two of the big producers in South America to just turn the volume up on their production, and the market is awash with this stuff. How wrong was he?
I think that maybe at that point in time, that it might have been right. But where this market is going to, it's very difficult to see that being the case. I think a lot of commentators are now looking at this market demand being around 1 million tons a year of chemical by 2025. It was only a few years ago that was the projected number for 2030. It's now been brought forward to 2025. With what we're seeing demand could way exceed that by 2025. And the reality is, I don't think that the lithium industry is going to be able to supply it. So, the market, you would talk about volume, the market requires a certain amount of volume by 25. I think that volume is increasing dramatically with adoption, particularly of electric vehicles, just accelerating away. And the industry is not going to be able to supply it. Plus, we're now getting obstacles coming in from permitting of projects, securing of equipment, or finalizing feasibility studies for projects. And it's one of the ways I think that Lepidico is extremely well placed in that we've got a project pretty much ready to go. Like it is fully permitted in Namibia, and in Abu Dhabi, we're building on an industrial park, and they want us there. Like, there is so much opposition to these natural resources projects, particularly in developed countries.
There is. So just want to stick with this, the supply demand, because that's the thesis, right? We've got to get the thesis right. So on the supply side, obviously Rio's been knocked out of the equation. Do you think they'll come back on, or was that the door is firmly shut and locked?
I think that there'll be efforts to bring it back on. I've got no idea as to when it might be able to be resurrected. But we're seeing this all over the place, Matt, that there is real opposition to natural resources projects, mining projects in developed countries. No one wants these things in their backyard. In Namibia, we are in a very arid environment. We're on a government property, and the local people and the government want us there because it's all about job creation. We're not displacing anyone. We're not going to be affecting anyone in the immediate environment. It's the perfect location for a mine.
No, we know a lot about Namibia because of the uranium producers there. In fact, we've got a piece coming out soon about doing business in Africa. Namibia is a big part of that. But just come back to the South American players, because we've interviewed a lot of lithium companies over the past 2.5, 3 years, and they've been struggling to get financing for pilot plants, let alone commercial operating plants. Are we saying that the market has changed so dramatically in the last couple of years that will no longer be an object, a bump along the road to get over? You think there's going to be more money looking at lithium based on what you're seeing happening with pricing at the moment?
Yeah, absolutely. So I think what we're going to have to see here in the lithium market, you mentioned price a little earlier, and obviously prices are up at record highs and probably going to be pushing higher. There has to be a medium to longer term sustained incentive price. The big question is, what does that look like? Okay, so we're already seeing lithium carbonate prices up around $60,000, $70,000 a ton. We've been hearing from the industry that prices of up to $100,000 a ton are going to be quite possible. We'll probably see prices test those kind of levels. That's not sustainable. The question then is, what is going to be where will prices pull back to a sustainable level to incentivize these projects that you're talking about? Because the industry absolutely has to have them. Otherwise, we're not going to be able to be manufacturing batteries. And there's some of the word that we're starting to hear now is $30,000 to $40,000 a ton is the sort of the price range to be incentivizing the sort of capacity that new capacity that's required for the second half of this decade.
It'll find its own level depending on what the supply side looks like, and a few of the other sort of broaden this out a bit. A few of the other things that are going on in the marketplace are around, people's understanding of the different types of lithium products in terms of, carbonates through to, hydroxides, etc. And, what the pricing will do, what the pricing does, and the incentive price will become what it needs to become depending on the supply. But there's also the technology component to this, which is some companies just don't have the necessary skills in-house, and they're reliant on either consultants coming in or bringing in what we're seeing a lot of is Chinese partners to solve or crack the code, as it were. So there's a kind of, it's a very mixed market. It's a very sort of fragmented market. And then, of course, you've kind of got the DLE component from a few companies out there, and perhaps, a few suffering from actually not necessarily being able to deliver on that front either. We should talk about Lepidico in a second. We should. But how are you seeing people's understanding of the lithium market affecting, the investor behavior out there? Do you think people understand lithium enough yet?
I think that there are pockets of good understanding of the lithium market, but I think an awful lot of investors and also commentators, for that matter, are coming up to speed in this place. We've been now immersed in this since sort of 2015, 2016, and we've now got the benefit of intelligence coming through from our relationship with Traxys, and they've been arguably trading lithium chemicals longer than anyone else since around 2009. So I think that we've got very good experience, and also we can pull from Traxys on this. So the market is evolving so rapidly. It is very difficult, I think, for a lot of people, both within the industry and also in the investment community, to be keeping up with what's going on.
So I'm intrigued. Like, how does Traxys play this, right? Because it's got customers. They've got an offtake with you. They've got customers they need to flip this onto. What do you know what those conversations are looking like now? Obviously, Traxys must be pleased they've got the supply from you, but are they? I'm trying to know, how do they take advantage of the situation without actually saying do they take advantage of the situation? But it's quite a nice position for them to be in right now.
No, absolutely it is. And so they've got long-standing relationships with consumers, lithium consumers, across the industry, be it in China, other parts of Asia, Europe, and to a lesser extent North America, because it's emerging. It's really an emerging industry there. So they've got those are long-standing relationships that have stood the test of time, and they're communicating quite openly about it. We have a very open relationship with Traxys. We have Lepidico people on almost all of these calls that Traxys is having with consumers. So we're negotiating these back-to-back offtake arrangements in collaboration with Traxys. So we've got very good visibility on what consumers are saying to us and the experiences that they're having within the market and how they're seeing the market themselves evolve.
See, but the bit I'm intrigued with is Traxys need to go and secure a lot more lithium, right? Because otherwise they're going to have some very disappointed customers, because you're going to have customers saying, I'll take everything you've got, Traxys, or I'll take 50% of what you've got, whatever the big numbers are. But it's going to be, the numbers are significant now. The game changes. The game is afoot. So that's what I mean by taking advantage of the situation. They're going to have to go and tie up things. Do you think there are enough projects out there near production for them to be able to do that? Because, you give us a clue there, and I can confirm it through our conversations with battery manufacturers and OEMs, that the supply, the buyers the buyers are tasked with, do not let us run out of X, Y, and Z commodities. That is your job. And I want you to go and get that now, not 2025, not 2027 for a 2030 delivery, now. There's very difficult conversations, and it's going to get a little bit heated out there, which is great for companies like yourself who are near production, great for Traxys, but this also comes with problems of, well, how do we take advantage of this?
No, you're exactly right. It is difficult to actually see how that occurs, because there's no shortage of early stage projects out there. But how many of those projects can actually transition efficiently and in a timely manner to having a definitive feasibility study like Lepidico's got? And then being able to get the offtake in place, the funding in place, the final permits in place to be able to transition into development. Like, for a lot of these projects, those are enormous obstacles. And so I think for any of these customers, be it consumers or also groups like Traxys who are trading companies, you can put your foot on some of these projects at an early stage, but the reality is not all of them are going to be successful. And I think that there is a tendency to wait to see how projects evolve. And we've seen this in discussions we've been having over the last 3 or 4 years, that once we got the definitive feasibility study, once we completed our ESIAs, once we had our greenhouse gas emissions report, which was done by GHD, we can demonstrate the credentials of our project. And that resonates with consumers. And so I think that's what's leading us now has led us to be able to enter into a binding offtake agreement with Traxys, but is then also allowing us to have these really very fruitful discussions with actual end consumers.
I often want, the ESG is a big component, and I hear every day from every single company we speak to, and they've got various understanding and levels of delivery against that broad framework of ESG. what's it actually mean on the coalface? What does Traxys demand of you? What does Traxys's customers demand of it, and therefore you? What is the code, the level that companies need to reach going forward?
I think that the first thing is to actually be able to demonstrate what the exposures are of the project. So be it greenhouse gas emissions, it's not just CO2, for example. Methane emissions are far more, have a far greater effect from a warming perspective than CO2. So it's just that the data is presented on a CO2 equivalent basis. Okay, but so having the detailed assessment of greenhouse gas emissions for a project, water usage, land usage, like those are probably the three big items that that lithium projects really need to be able to demonstrate what the impacts are. And then if there are emissions, and there always will be, what can be done to progressively reduce them. So, for example, for our phase 1 project, which is a vertically integrated project, mine, concentration, through to a chemical conversion to produce fine chemicals. So for that vertically integrated package, our CO2 equivalent emissions, so total greenhouse gas emissions, scope 1 and 2, so that's at the operating sites, plus all of the power that we use and its associated emissions, we're about 25% lower emissions than a typical vertically integrated spodumene business. We know where our emissions are, though. Like, our largest single source of emissions is in the natural gas that we use to produce process heat. So this is in a boiler. Like, we're heating water up to 160 degrees to produce steam. It's not a high temperature, but that's 60% of our total greenhouse gas emissions. The boiler that we're looking at putting in the chemical plant in Abu Dhabi is going to be hydrogen enabled. So once we can secure a feed of hydrogen from that, and what color hydrogen that is, I can't tell you right now, but it could be any one of the colors of the rainbow pretty much, but we're obviously going to be ideally looking at green hydrogen. That could take out CO2 emissions for the integrated project down to 3 tons of CO2 equivalent per ton of lithium carbonate equivalent produced per year, or produced as a ratio. That would be best in industry. Now, that's scope 1 and 2 emissions. Scope 3 emissions we can't estimate until we come into production, because we need to know exactly where we're getting all of our reagents from, where the products are going to. We can't determine all of that at this point in time. GHD, who did our greenhouse gas emissions report, though, opined that because of our byproducts, we should score extremely well on scope 3 emissions. So I think it's only once you've got a definitive feasibility study that you can actually coherently be evaluating what your scope 1 and 2 emissions are. When you're at scoping study, it's very easy to, kind of with all due respect, wave your arms around and say zero carbon. But in reality, I actually struggle to see how virtually any projects are ever going to be zero carbon unless you're actually committing to credits.
Yeah, nice, cheap and easy way out of it. Well, not cheap, I say cheap, but an easy way out of it. But I mean, here's a question for you, Jay, are we sort of marching towards a bifurcated market in terms of pricing in that case? Because if the supply side is not quite up to it, the demand is overwhelming, there's going to be a very meaningful discussion at multiple boards around the world where say, well, do you know what? If they're that desperate and in need of what we've got, why add the cost at our end? Right? Why bother going through this? Because some are going to be more capable than others, right? Unless you're forced to buy credits, but then you're kind of just you're just passing the money around the table, right?
That's right, and I think it's a little different to that. Whether the market does become bifurcated or not, I'm not sure. Like, I think that we're going to see a market with such strong demand globally that pretty much any lithium units that can be produced, whether they're clean lithium units or dirty lithium units, are going to get consumed. The bigger question is, where are they going to get consumed? Well, the reality is that given the stringent requirements, particularly in Europe and also emerging in the US, then obviously that's where the clean units are going to be demanded. And there might be a premium for those. The dirtier units may well be going to other parts of the world that are less stringent when it comes to considering the upstream CO2 impacts. So I think that the lithium units will get consumed, and you might be right that they might become somewhat bifurcated from a price perspective, but it's going to probably mean that the pricing pressure is largely going to be in the Western countries.
Yeah, but it comes back to your comment earlier, not in my backyard, please.
Yes.
Right. And, and we're seeing this in coal. We've got an Australian billionaire working with the funds saying, oh, we're going to take our X energy company and we're going to remove the coal. No, you're not. You're going to just place it to somewhere else. That's what's going to happen. And I just think it's interesting, this kind of, at the moment, lack of joined up thinking. But I totally wholeheartedly agree with you. The mining industry needs to kind of clean its act up. More companies doing what you're doing in terms of really looking at how you identify and how you remediate, not necessarily remediate, how you fix those problem areas and be able to tell a proper green story. Need a lot more of that going on. But look, I appreciate the background of what's going on in the marketplace. It's going to get a little bit exciting this year, I suspect. But what can you tell us about you? You were only on a couple of weeks ago, so for those who perhaps haven't seen that interview, maybe just give us a quick run through of where you're at with regards to funding and moving the project forward.
Sure. So funding is progressing, pushing forward. For those who haven't seen the previous interview, Development Finance Corporation, the US government's funding arm to projects in developing countries. They are now well advanced in detailed due diligence. They've appointed their legal counsel, so we're getting into evaluation of key contracts, etc. So we're looking at wrapping all of these threads together in the second quarter of this year, with the objective of them being able to make a final investment decision, hopefully early in the third quarter. It means that, like, we have been targeting getting first production late 23 and first shipment out in late 23. That's now slipped into 2024. But the important thing here, in my mind, is we have got a project that's right on the cusp and being ready to go. There are very, very few other projects out there in that position. The other thing that we're focusing on in parallel with this is growing our resource base. To your points of earlier, the market needs more lithium units, and they want to see us, and the customers that we're talking to want to see us demonstrate that we can grow our output. So I was in Namibia last week, first time in 2 years. And it's amazing how when you get on the ground, you can really be moving things forward. We had some fabulous meetings and conversations. We're drilling on site right now. We should have a second rig on site, diamond rig on site this week. The RC rig is moving back down to Rubicon. So as of next month, we should be starting to get assays coming through. We want to grow this resource base. We don't need a lot of tons. Like phase one, ore reserve is just under 7 million tons. It's not a big tonnage. If we can get another 7 million tons, we've got a phase two project similar size to phase one at 5,000 tons a year of lithium hydroxide output. I think we'll see our Caribbean assets produce a lot more resource tons than that. Realistically, I think if we can be getting sort of 12 million tons, we got a 10,000 ton a year phase two. I'd like to see the resource grow to over 20,000 tons, 20 million tons, which could give us a 15 to 20,000 ton a year project. We probably won't be able to achieve that latter resource growth objective by the end of this year. I think that we can, a reasonable target for resource growth for this year is probably adding another 10 to 12 million tons. But that's a very, very substantial amount. And to your point, again, that's what our customers want to see. They want to see us being able to grow our lithium units in the second half of this decade. And then it'll be coming from brownfield sources. We're a known quantity as far as all of these ESG criteria are concerned. And we'll have an operating business from phase one. We leverage that as a platform to then be able to grow the business in a very efficient manner.